Now, in their recent report, S&P Global Ratings say that they see parallels between India Inc. and their Chinese corporate counterparts of the early 2000s. Now, they anticipate top Indian corporates to double their spending and capex over the next 5 years. Neel Gopalakrishnan, who is the director of corporate ratings at S&P Global Ratings, joins us now. Mr. Gopalakrishnan, firstly, thank you so much for joining us today. Festive greetings to you and your team as well. It was a very interesting report that you've put out. You're drawing parallels for India Inc. to their Chinese counterparts. If you could summarize those parallels for us, what are the kind of parallels that you are seeing for Indian corporates going forward?
Sure. Firstly, thank you for having me in the studio, and it's a very festive atmosphere here. Nice to be with you at this time. We have been positive on the outlook for Indian corporates, the growth potential, and also the balance sheet health. And we have reiterated this message a number of times. So this report was actually building on that, and we drew on some lessons that Chinese corporates experienced during their period of peak growth in the 2000s. And we compared that with what Indian companies are going through now. And we saw a number of parallels. Of course, there are differences as well, but since you asked about the parallels, the most common similarities we found were from a perspective of government policies which are supporting corporate growth, the promotion of policies in order to increase self-sufficiency, export potential, building domestic capability, and also on the infrastructure side, where the government is focusing on building infrastructure, reducing logistic inefficiencies, and thereby creating an environment where corporates can grow and become stronger.
You mentioned in your report how logistics cost has gone down as a percentage of GDP, and these are smaller things, but they make a big difference on overall GDP as well. But when you said there are differences as well, we need to talk about that as well, right? Because we've seen the way Chinese economy has grown versus how India has grown. Of course, it's growing at a good pace, but what more needs to be done, which should be parallel to Chinese counterparts? What are some aspects that you saw is not happening in India?
So some of the similarities that I talked about, infrastructure development, the setting up of industrial clusters, special economic zones, these really helped Chinese companies grow in the 2000s. Yeah. And as we commonly say, they became a factory for the world.
Yes.
But a big change happened around the 2010s when Chinese corporates moved up the value chain. And this they did by investing heavily in technology, innovation, and by increasing spend in R&D. I would say in India, there are two big challenges now. One is on the technology side. We know corporates are not spending enough on R&D, so there needs to be more focused spending on R&D. And whatever spend there is today is quite fragmented. And this spend on technology is important from a perspective of strengthening supply chains, which is one of the reasons Chinese corporates became so competitive. The second challenge is in India is execution. Things are improving, but implementation, particularly greenfield projects, it remains a challenge. Issues around land acquisition and so on. And this also has implications for FDI inflow. So I think these would be some of the areas where things, if they improve further, would be really positive for corporate growth.
So is the lack of availability of skilled labor a challenge as well for India Inc. to execute their growth plans going forward?
I wouldn't say that. As we all know, there is a lot of talent in this country. So there is no shortage from a skills perspective per se. But if you look at specific areas like say R&D, for example, I think that is where probably there are skills gap. And maybe the incentives, we now have some design-linked incentives and so on to promote the R&D side of things. But I think that together with skills where greater collaboration between, say, universities, the public sector and the private sector, those could really make a big difference in the future.
What about financing? Because, you know, there's a difference. There's been a difference in debt levels as well for both the economies. How do we go ahead and finance the R&D spends that you're talking about, the technology spends that we are talking about? I think we are internally sufficient for that?
I think you raised an excellent point. In fact, one of the differences we drew between China and India was the involvement of the state, where the Chinese government provided significant direct financial support to corporates. In India, that's more limited, but offsetting that is the fact that corporates have plenty of funding access today. So financing is not a constraint on their ability to grow. Specifically on R&D, the government itself is coming up with plans where they are investing in R&D, and that has to be supplemented by the corporates. It will probably happen, and we are seeing that. And as I said, there are incentives, but incentives alone will not move the needle. It needs to be a concerted effort, and at least on the technology side of things, we think it might take a few years, but things are getting there.
You know, one interesting point that you mentioned in your note is that they'll be less reliant on exports, the Indian corporates. There are still a lot of export-heavy sectors in India. What more should be done to offset that or to turn those export-heavy sectors into domestic-oriented sectors? And if that happens, what kind of a runway can these expect in terms of growth?
Right. Good question again. And again, if we draw a parallel with China, in the early 2000s, interestingly, the Chinese domestic market was comparatively small relative to what India's domestic market is today. So the growth largely came from exports. Whereas in India, domestic growth is very strong. And in a number of sectors, we still import to meet demand. If we take the steel industry as an example, companies have significant growth plans, but the demand is growing as well that we still think it will predominantly be servicing the domestic industry. So to be able to export, two things. One, they'll have to grow even more aggressively. But in doing that, you also need to be mindful that India's own growth could have implications for the regional demand-supply balance. So that could affect profitability. And when China was growing, we say China didn't have to compete with China. But when India is growing, global competition is so high that you'll have to keep the global demand-supply in mind.
We are in a different we are in a different era right now. We are seeing a lot of macro changes at global level, at India level as well. But thank you so much for joining us today with your insights and this very interesting report.
Well, thanks so much for tuning in to CNBC TV18. Make sure you follow us and stay updated on all our social media platforms. Well, thanks so much for tuning in to CNBC TV18. Make sure you follow us and stay updated on all our social media platforms.